Hi, welcome to today's webinar. We'll probably call this Accounts Receivable 1. There's a lot in this webinar, and so I'm going to give you some general information. More specific information will be in future webinars on accounts receivable. First thing, the basic accounting in accounts receivable, and again, this is very basic. We're not looking at all the journal entries that are mentioned in the text, but the normal ones, the ones you see 80% of the time. Generally, we'll debit accounts receivable and credit sales when there's a credit sale, and then at a later point, maybe days later, we will debit cash and credit accounts receivable when there's a cash collection. Now, generally, you don't have any problems in accounts receivable until year end. And at year end, what we have is that the balance sheet shows what we could collect. Well, if my accounts receivable, say, were $100,000, that would represent what I could collect, but I won't collect 100% of the accounts receivable. That means then that what I could collect is a pipe dream. And under accounting, we want to value our assets at fair market value, which means we want to show that what we are likely to collect. And so let's assume that for a moment that we're likely to collect $95,000. Then there's a difference between what we're likely to collect, $95,000, and what we could in a perfect world, which is $100,000. So thus there is a difference, so we need to set up an allowance for that difference. So the allowance for doubtful accounts, all it really is a way of saying, okay, here's your gross receivables, here's your net receivables, and the difference between the two, between $100,000 and $95,000, is our allowance. So it's an allowance for a doubtful account. It is a contra asset account because we're going from gross receivables, $100,000 on the books, to net receivables, which is what we're likely to collect, $95,000. So that allowance then would be $5,000. Contrary, it's subtracting from gross receivables. So it is a contra asset. It is a subtraction from assets. So we adjust our gross receivables to an amount we are likely to collect. There's two methods that we will use, which we'll see on another video: the percentage of net credit sales or the aging method. Either of those is appropriate to use. The idea is that we adjust it usually at year end, and by adjusting, we are measuring the proper amount of expense, uncollectible expense or bad debt expense, whatever you want to call it, to the year of sale. The direct write-off method, which the book also illustrates, is not a GAAP method, so hence we are not going to talk about it much, at least in these videos. The allowance methods are GAAP methods as they properly match the bad debt expense to the year of the sale. So there's a proper matching of revenue and expense. So bad debt expense, also known as uncollectible accounts expense, is an expense account, and it measures expected uncollectible accounts to the year of sale. And hence, by so doing, we are following GAAP methods as we've illustrated throughout the text. The general journal entry, and we'll get more specific in this in later videos, is to debit bad debt expense and credit the allowance for doubtful accounts. This, again, as we mentioned earlier, is usually a year-end adjustment. On the balance sheet, we will show accounts receivable gross, less the allowance for doubtful accounts, gives us net realizable accounts receivable, in this case, $14,000. What the net, in this case, the $14,000 represents is the amount that I am likely to collect. $15,000 represents the amount that, in a perfect world, I could collect. By showing the $14,000 on the balance sheet, we are showing people who want to look at our balance sheet a more realistic view of what our assets are really worth. We are more likely to get 14,000 than a pipe dream of 15. So we are being more conservative as accountants, and we're showing what is a good value to show to the readers of the financial statement. So these are your basic accounting entries here. Debit accounts receivable, credit sales for credit sales, debit cash, credit accounts receivable for cash collection. Of course, there are many other types of entries that are mentioned in the book, and some of these we go over in a later video. Again, there's a problem at the end of the year in that we show gross receivables and we really need net receivables. That difference causes us to create an allowance for doubtful accounts. That is a contra asset account, meaning that as it goes up, the net realizable receivables goes down. So as the allowance gets bigger, our amount that we are likely to collect gets smaller. There are two acceptable methods, percentage of net credit sales and aging method. And the general entry is to debit bad debt expense, which is an expense account, and credit the allowance for doubtful accounts, which is contra asset account, generally at year end. So it is an adjusting entry. And again, you got an income statement account and a balance sheet account here, as mentioned earlier in the course that we need in adjusting entries. So that's all for this video. Look forward to seeing you on the next video. Take care.